What's up, everybody? This is a video about the Gamestop saga. It's a quick history recap of how we got to the point where we are today, and also it looks at a couple of the claims that have been floating around, tries to put a fresh perspective on them, or put a bit of a sober perspective to them, and tries to kind of evaluate whether those claims have any merit or not. Quick disclaimer, this is not advice in any way. This video is purely for entertainment purposes. Please do not make any financial decisions off the back of what you see in this video. It really is just a little silly video that I'm making to try and help a couple of people understand what is happening. So to do that, I'm going to be using a couple of graphs. I've tried to make them a little bit more interesting, but essentially to get to the graph that I want to use to tell the story, I just quickly have to break it down a little bit. So the first element that will appear on the graph is the daily adjusted close. This is basically the price that the share closed on a public exchange on a daily basis, right? The second element that you will see on the graph is this orange line over here, representing the Redditors, if you will. But for all practical purposes, this represents the main street or the man on the street's purchasing activity. Whenever you use a brokerage app, you are buying on the public exchange, and your activity is represented on the public exchange daily volume. Then I will also overlay the FINRA data. So FINRA is basically a data set where all the hedge funds and institutions, or the so-called over-the-counter markets that trade amongst each other, are required by the SEC to submit their daily short volumes as well as their daily total volumes. This is to try and address the information asymmetry that exists, where you only see the total short interest summary like on a bi-weekly basis. The FINRA OTC submissions on a daily basis shows basically what institutions and hedge funds are busy doing amongst themselves in terms of shorting or trading outside of the public exchange. So over here, you can see, for instance, overlaid the overall short volume on a daily basis in terms of the GME stock. I will also overlay the total volumes of the over-the-counter trades, or the FINRA dataset, to also paint a picture of not just the shorting action that's happening in these institutions, but also what's happening in terms of buying. So if you put them all together, you get this super complicated, very messy graph, which is the exact reason why I had to break it down into its individual elements, where we can see the over-the-counter shorts that have happened since the beginning of January, or roughly the beginning of January, the overall volume or trading volume that's happened roughly since the beginning of January, what the public have been doing on the public exchanges, and then also what the closing price was every day. Right, so how did we get to this point? How did the whole GameStop saga start? So GameStop is a retailer. They sell games. The business has been struggling under COVID, but there's a lot of people that do believe in GameStop's future, and especially it's got to do with the fact that there has been some very interesting people that have come on board that are looking towards reinventing the company, going forward into a digital games company. They're busy closing down all their leases and transforming themselves into the digital market, and a lot of people feel that the fundamentals of the company is reasonably good, and with the new management team that have come on board, that the company in itself is looking like a pretty good long-term hold or value investment for what it was priced at. The other thing people noticed was that the institutions, or the hedge funds specifically, did not agree. So there was an incredibly high percentage of short interest or shorts against the company. This is behavior that's pretty common from hedge funds. They would take massive short positions against companies and then use their influence in the media and use various other techniques to try and drive down the price of a share price and thereby make a buck against struggling or ailing companies. So there was a bank or a group of people on Reddit that saw this together with the Chewy.com founder that came on board. There was a bit of a change in the amount of shares that were available since a lot of it was purchased by the Chewy.com founder, which led to the situation where the amount of shorts against the company exceeded the amount of float or available shares in the market, and that led to the Reddit community called Wall Street Bets to basically speculate that there was a possibility where you could enforce what's called a short squeeze, where if you take up enough of the float and there's not enough publicly traded shares available, you could drive the share price up potentially, or prevent these different shorters from being able to close their positions, which would then cause a short squeeze where the price of the share would go up significantly, since the market would pretty much then make the price for what these shorters can cover their positions for. So that roughly has been going on for a few months gradually, but really started getting momentum once the founder came on board and the available float changed for the company. The second kind of milestone that happened is, as we said, is that people started realizing that the available float had changed and that the company was way overshorted, and the Redditors started buying. And equally, from the FINRA data, you can see that the institutions kept adding to their short positions, believing that the company is not worth what people are saying. You see there's a bit of buy activity as well, where they were covering their positions that were probably out of the money with. But it started reasonably tame. The share price was kind of hovering between 0 and 50. There was a big spike initially of the Reddit army going after the stock. Institutions kept shorting it, and more importantly, there was some buying activity from institutions as well, probably starting to cover some of their shorts that were out of the money, although one cannot know for sure. Next major milestone, and the one that really was the triggering event, or the accelerator, if you will, is Citron Research took aim at Main Street, or at the Redditors, and tweeted about the whole situation and the build-up and the attention it was receiving, saying that these Redditors, or these buyers at these levels, are suckers in this poker game, and that the stock was going to go to $20 very fast. And if you've been on the internet long enough, calling out a big group of passionate people on Reddit in that way invites only one reaction, and that reaction they got very quickly. So the news quickly spread about the situation, about the potential of a short squeeze. As more people became aware of it, people started piling in. The volumes in the public exchange started spiking, and what you had was that the price started rising ever so slightly every day, more aggressively, right? On January 12, it actually rose so quickly that it started hitting some of the circuit breakers in the market that's put in place to prevent extreme volatility, where markets get halted for a few minutes at a time, in times where there's big rapid movements upwards or downwards. Then around about January 25, it was the peak mania, if you will, or peak awareness. News had spread to more and more people. The Wall Street Bets Reddit group or channel grew substantially. People around the world started becoming aware of the situation, started hearing about the hypothesis of a potential short squeeze, started taking interest in this situation. And from this graph, you can also see that there was still many institutions that continue to add to their short positions, but also potentially covering their positions, but we will talk about that a little bit later. The real triggering event was when Elon Musk tweeted Gamestop, which was the meme associated with the whole movement. and along with a link to the Wall Street Bets Reddit community or discussion group, and that really sent it flying, and the share price went very quickly from the hundreds and to 150 range and ended up closing all the way close to 350 on the day. At that point, the shorters were out of the money, regardless of the fact that they started clearing as much as they can or covering as much as they can. So Melvin Capital and especially was the main hedge fund that had the biggest exposure to this risk. There was also a couple of other hedge funds that bailed them out and gave them some more money. But the rumor was on January 27 that they had closed the majority of their positions or their shorts, right? And this was where things started getting a little bit murky. For the short interest data out there, it's a very slow moving data. The overall combined short interest figures only get published on a bi-weekly basis. So nobody was really sure about what the state of the nation was. Like, did they really cover? Were they being slimy hedge funds that were trying to bend the truth? There was theories about them manipulating the market, creating synthetic longs. There was theories about a whole range of things. And nobody really knew. It was pretty much what you describe as internet mania. But the official position from the company was that they had covered their shorts. Nobody believed it, and subsequently, after an initial drop of a little bit, the buying power came back and maxed out over 300 again on the 29th. The reason there was a bit of a dip in between was a very controversial move. So once the rumor started going around, or the announcements went around that Melvin had covered their position, which nobody really believed, there was lots of weird behavior happening, specifically a brokerage app or a trading app called Robinhood, and a few other brokerages like Fidelity or Interactive Brokers started restricting Gamestop buys, which seemed to be like that Wall Street was conspiring against Main Street, preventing them from forcing the credit squeeze, and that there was like something foul afoot or some manipulation happening at that stage. Then, just before markets opened on the 29th, the SEC finally got involved and kind of warned brokerages and Reddit users that it will be keeping a watchful eye. And at that stage, there was reports coming out that short sellers had endured market losses of up to $19.8 billion, according to a company called S3 Partners. And on January 31st, Melvin Capital themselves kind of announced that they had a 53% loss in January from not covering from their short positions that were out of money that they had to cover. So in a way, it is an amazing story of the public coming together and coordinating, and really teaching this shorters a lesson, and really costing them a fortune for taking such an irresponsible position in the first place. Right. So that brings us up to speed. But what does it mean? Like, there's a couple of claims that I want to explore. So right in the beginning, when the buying pressure was at its peak and the price was going up, there was a lot of claims around that the greedy hedge funds doubled down on their shorts, and actually, instead of covering and getting out of their positions, they ended up like actually buying more short positions and then thereby raising their short interest. Now, if you look at the FINRA data, and specifically at the OTC short value or short volume, then we can see that during the time leading up to the 26th, 27th, this period where the spike happened quite aggressively, and before the short volume started tapering down quite a lot, there was a lot of short trading volume coming in from OTC markets or institutional markets. Specifically, we see right in the beginning when the story broke, there was a massive spike of the short sellers trying to short the stock when initially the Redditors went against them and started buying up the stock and doing all these things that have led us to this point. In total, if you add up everything up to the point where the short volume started tapering off significantly, you're looking at about 193 million shorts short positions that were taken up over and beyond the initial short percentage that was reported or that formed part of the original hypothesis. These shorts were taken at various points at the price ladder. So, anything looking from like 30 to all the way, there continued to be shorts all the way to today, obviously. But up to that point, there's easily shorts out there that were taken at the 200 level. And this is something that people forget quite often, is that, even if the short data comes out on the 9th of February, a lot of the shorts could have been exited and new positions could have been taken at a higher amount, right? So even though the short interest percentage could be incredibly high still on the 9th of February, it's not to say that those shorts are still at the super low levels that would force a gamma squeeze or would force the short squeeze. It could very well be that the most of the shorts out there are currently floating at a higher range, and we'll try and kind of calculate that a little bit later. So the claim that the greedy hedge funds doubled down on shorts, were they really that arrogant that they were already over 100% of the float, and that instead of just getting out of the position and cutting their losses, they actually doubled down and went at it even harder? It does appear that is true, right? There's definitely was more and continues to be more shorting activity that's happening in the market, right? Second claim, the hedge funds have covered their shorts, right? So this one in particular has been a very controversial topic. There's been unnecessary mixed messaging from companies like S3 in terms of sending tweets around what the short interest is and then changing their calculations, and then following, almost like a few hours later, changing their messaging. There's been various reports and speculations in the media, all looking incredibly suspicious and incredibly like it is Wall Street buddies helping Wall Street buddies. And this, of course, drives conspiracy theories, it drives the misinformation, and becomes really, really hard for us to discern what the true situation is. But once again, the over-the-counter data that is out there does shine a little bit of light. Now, as I said in the beginning, I am not an expert. I am very happy if someone is going to show me that I'm wrong in some of my points. I am currently diamond handing very, very hard in a substantial position, and it is unpleasant. The very reason why I'm doing this video is for myself to take a moment and pause and reflect on where we're at, and how we got into this space, and whether the opportunity in the central hypothesis still holds. But if we look at the OTC data, there is short volume, new shorts that have come in. So that we know is there, right? But if we then assume that, if we look at the total volume, this represents the pink over here represents everything that is not a short, right? And if we look at all the OTC volume of other trades, some of which could have been covers, right? It could have been institutions like hedge funds covering and buying back shares for their short positions. There's 384 million other trades beyond the 261 short trades that have happened, right? So the delta between the two is roughly 122 million, which is, unfortunately, enough to cover a substantial percentage of the short position that the central hypothesis was built around. I don't have the exact figure off the top of my head. This is a YouTube video, so I'm not holding myself to like a CNBC level of production. But if I remember correctly, the number of shorts that the speculated was around the 70 million range for the central hypothesis, and the float was around the 40 million range. I stand to be corrected. And then now, given some of these trades might be hedge funds and other institutions that are actually betting against the shorters. So some of these buys could have been people that actually took proper long positions, going with the Redditor's hypothesis, trying to force the short squeeze. But it is probably safe to say that if the shorters were busy covering their shorts, that they wouldn't have necessarily tried to do that over the public exchange, and that they would have used the OTC market to do that. And the problem with this graph for me is that there is enough volume to say that they could have potentially covered, even by the date that they said they did, which was roughly here by the 27th or the 31st, if I remember correctly. There is substantial other trade volume in the over-the-counter markets that could have covered those trades. So, where does that leave us, right? Like, is the claim that the hedge funds covered their shorts true? We don't know. We certainly know that they cycled some of their shorts, and they probably in that process would have covered some of them. And there certainly is enough volume. Like the whole rumor about there not being enough volume to cover their shorts, like the volume in just the OTC market is enough to cover those shorts, right? If you combine that then with the public exchange volume, like there's a lot of volume to cover shorts, or to at least buy shares that is changing hands pretty quickly. So, is the claim that the hedge funds have covered their shorts true? In the very least, I think it would be prudent of us to consider the possibility that it's plausible. Right, is the squeeze still coming? So there is a lot of people still holding on to the central hypothesis, saying that the news media outlets are busy lying, that the squeeze is still on hand, that it's all made up, and that everybody should hold out and hold the line and keep believing in the central hypothesis. Now, if we go back to the previous graph, which is really the problem of there being more than enough other trade activity that may have covered the shorts, we can do one other thing. Right, so for all the new shorts that we know are out there, if we take those and we take the adjusted closing price for that day, and we work out roughly for all these new shorts, which is probably not true because some of them would have been exited already again. Like, once again, I am not an expert. I can be completely off, and I would love for someone to correct me. This is a source of great anxiety in my life. But if we took all the new shorts and the price at which they were bought roughly, we work out with the volumes and we work out an average, the new short positions roughly averaged about $100 or $100.4, which is interesting because it does mean that there is at least 260 million new short trades where on average the entry point is about $100, right? Now, if we look at what has happened, like after the massive price jump, the volumes did drop substantially, like in the market. If we look at the kind of like just on the public exchange, volumes went from the high of like 100 or almost touching 200 million in one day to roughly like 50 million, maybe even lower some days, of not trading terribly high. So it does appear that the public is currently holding strong, or that a lot of people are actually holding out, hoping that a gamma squeeze or that a short squeeze would happen. And if we kind of look at the institutional behavior, they are so deep in right now that they're not really buying as much new short positions, and equally they're not doing any other trades either, right? So right now we are in a kind of holding pattern, and it could be that some of this 122 million shares that's been bought is being used to do short ladder attacks or aggressive buying techniques to try and drive down this price below their average price, or like short price of $100, right? Which is interesting because it's almost, if you're familiar with game theory, it is a prisoner's dilemma, right? Because in order for us to be able to force like the situation of the central hypothesis, my theory is that the collective public would have to drive the price, or the price would have to go up above the 100 level for these new shorts to be out of money. And we see that that given enough volume and enough public sentiment, that can be achieved very easily given the low amount of volume that is out there, right? With the first surge in buying from public, the price went up radically and put all the shorts out of money. But then the volume kind of went away, and people started losing faith, and they probably ended up selling a lot of their shares. A lot of paper hands started folding, and together with the loss in volume and potentially the short ladder effects, it does appear that the theory that there is like still something on is there, kind of, right? It's not at the original like $20 range that the original shares were at, or shorts were at. It's been replaced and recycled with a whole bunch of new shorts, but all those shorts were kind of done mostly under $100 range, with only the real big spike of the last week where there has been a couple of more shorts that have gone into the mix, maybe bringing the average up a little bit higher than what it was before. So it follows, my humble opinion, is the squeeze still coming? It's kind of meh. Like, I'm not sure, right? Like, because I'm not an expert at this. But nobody talks about the OTC data, and nobody like can give me a compelling reason why I'm wrong here yet. As I say, I really want someone to come and prove me wrong and explain exactly why all of this is a bunch of bullshit, and that I am an engineer and not a trader, and I have absolutely no idea what I'm talking about, and that will be great too. But I do think that if the public can stick to holding out, and potentially if one can, not force, but if it could happen that the buying power gains momentum, I do think that there is still something on here. But if people capitulate and they start selling, then chances are that the big squeeze will never really come, and that the squeeze that everybody is hoping for was this big spike that happened over the 27th, right? And that is my fear, is that people are inherently scared. There's lots of people that have put a lot of money in, and as such, like, I'm not sure, like, perhaps when the short interest is published, perhaps that will make people like more bullish on the situation, because there will be a high percentage of shorts still out there. What that data won't show is what the average position of those shorts are, and people may incorrectly assume that it's the exact same shorts from before. So I guess what I'm asking YouTube or the greater ether is, this is the way I see it. This is the way I understand it. It's not advice again. I'm certainly not proposing any coordinated activity. It's merely me trying to learn about the situation, trying to understand the dynamics, and I'm really hoping that there's way more clever people out there that can kind of break this down a little bit more and shine some light on it for everybody's sake.